Hello and welcome to today's lecture. I will provide an introduction to government budget and economics today. After the completion of the lecture, you will be able to understand the concept of government budget, study about the types of budget and principles of good budget, study about the types of government received and expenditure, understand the concept of deficit. Government budget. Government budget is the statement of estimates of the government received and government expenditure during the period of the financial year. Broadly speaking, there are various types of budget. Operating budget, the operating budgets of states and localities govern the routine revenue and expenses. For example, a city budget would cover employee salaries and benefits, police department expenses and office supplies. Capital budget. Capital budget differs from operation budget in that they fund long-term construction and renovation projects. Capital budget fund long-term projects like new buildings and needed renovation. Proposed budget. The President, assisted by the Office of Management and Budget (OMB), creates a federal budget proposal and submits it to the Congress. State governors, supported by their respective budget offices, create their own proposal. At the local level, mayors or appointed officials may have the responsibility to create proposal. Although Congress, supported by the Congressional Budget Office, state legislature and state council may ultimately pass different budget, the power to offer a budget proposal represents an important agenda-setting power. Department budgets. Federal, state and local governments have separate departments offering a variety of public services. These departments work with the executive in charge of budgeting to create a proposed budget of revenue and expenditures that the executive will include in the final budget proposal. Discretionary and mandatory spending. The U.S. federal budget includes both discretionary and mandatory spending. Various laws commit the government to pay for certain entitlement programs like Social Security, Medicare, Medicaid, and welfare program, as well as interest on the public debt. Conversely, discretionary spending covers programs that the government could cut. Defense spending represents the bulk of federal discretionary spending. Balanced budget. Balanced budget is a situation in which estimating revenue of the government during the year is equal to its anticipated expenditure. Government's estimated revenue is equal to government's proposed expenditure. Unbalanced budget. The budget in which income and expenditure are not equal to each other is known as unbalanced budget. Unbalanced budget is of two types: surplus budget and deficit budget. Surplus budget. A budget surplus occurs when income is greater than spending. When people, organizations or governments have a budget surplus, this means that they have extra funds which can be used to do things like retiring department. Deficit budget. The opposite of a budget surplus is a budget deficit, that is when your expenditures are more than your income. Principle of good budgeting. Comprehensiveness. The budget must cover all the fiscal operation of government, encompassing all public expenditure and revenues, to enable full and informed debate of the trade-offs between different policy options. Predictability. Spending agencies should have certainty about their locations in the medium term to enable them to plan ahead. Stable funding flows support departmental planning and efficient and effective delivery. Contestability. No item in the budget should have an automatic claim to funding. All policy and attached funding should be regularly reviewed and evaluated in order to ensure prioritization and optimal performance of spending agencies. Transparency. All relevant information required for sound budgetary decision making should be available in an accessible format and in a timely and systematic fashion. Budget information needs to be accurate, reliable and comprehensive. Periodicity. The budget should cover a fixed period of time, typically 1 year, and the process of compiling the budget should follow a clear and reliable schedule that is agreed upon and published in advance.
How to set a budget and stick to it. Nowadays, I know, it is not easy keeping your hard-earned cash in your wallet, even when you're trying to be responsible, right? I mean, we've all got a variety of need-to-have expenses like a mortgage, car repairs, and college tuition to pay for. I mean, never mind the like-to-have expenses, that you want to treat yourself to once in a while. Like a new pair of cool high tops or those fancy designer jeans. So I'm sure your question is, how do you keep all those things from chipping away at your bank account? Well, no matter who you are or what you're spending your money on, you could probably use a budget, especially when the average household spends 80% of its annual income on a range of necessary expenditures, which includes almost 60% on housing, food, gas, and insurance alone. Now, that's a lot to pay for, right? I mean, so then how can you ensure you're being as smart with your money as you can be? Well, by creating a budget. It's the tool you need to help you stretch your paycheck as far as it'll go. And now all it takes is just a little bit of discipline, planning, and most importantly, prioritization. While creating a budget may seem overwhelming at first, I know, believe me, the time you spend putting it together, that's going to certainly be worth it when the process of paying your monthly bills becomes a little less stressful. So where do you start? Well, setting a goal is always a good place to begin. It gives you something to shoot for. And then, of course, making a plan, that's going to set you in motion. So here's how to do that in 6 easy steps. Step 1, know your income. Seems simple enough, right? But knowing how much you can spend each month starts with knowing how much you take home. That means you can't build your budget based on your salary. I mean, it should be based on your net income. So get out some pay stubs and see what you're clearing after taxes, insurance, 401k contributions, and other stuff like that. Step 2, determine your basic expenses. Figure out what your fixed expenses are every month. Now these are the things that don't fluctuate or change dramatically through the year, like rent or mortgage payments, good old car payments and insurance, student loans. This is also a good time to make sure you have some kind of safety net to help pay for these expenses in case of an emergency. Like, let's say you need a new water heater or your car needs a new transmission. There you go. So if you have a safety net established, great. If not, there happens to be a video on this site called Easy Ways to Save on Everyday Expenses. And that can help you find some extra money to put towards that savings. Step 3, determine expenses that vary each month. These are the things that change based on usage, like your phone and other utilities, as well as your grocery bill. That could change. You could also add up all those flexible expenses like clothes, those jeans, restaurant meals, entertainment costs. These are the costs that you have control over. Step 4, determine what's really important. When it comes to creating a budget that works, you have to take a really hard look at what you feel is truly necessary. As much as you'd like to think you can't live without the latest gadget, this type of expense should go into the like-to-have category. So if you want to find the fluff in your budget, start digging into your variable expenses and rank what's most important to you. I mean, do you really need unlimited texting on your cell phone? If not, get rid of it. Are you watching all 437 channels of cable? No? Downgrade to basic. For more simple tips that, can help you save, check out that video I mentioned, Easy Ways to Save on Everyday Expenses. Because if you follow some of the tips there, you could save hundreds of dollars each year. Yes, hundreds. Step 5, follow your spending and review monthly. You want to give your budget a fighting chance, right? So just keep an eye on your wallet, and especially those credit cards, to make sure you're spending within limits throughout the month. It's easy to forget, right? And even easier for the small things to start adding up. So keep on it. Step 6, keep track. Find a way that works for you to keep track of your expenses. That can mean the old pen and paper, a spreadsheet, or one of those new fancy, fun budgeting apps. A lot of banks have these as part of their online banking. They're easy to find and use, so be sure to look for them. Then you just balance your budget. Keep your income information current and track your actual expenses monthly. After a few months, you're going to start to see patterns and figure out where you can streamline and make adjustments.
The important objectives that are sought to be achieved through a budget in an economy are discussed follows. Allocation of resources, keeping into view the socio-economic and other objective which a government wants to achieve, resources are allocated through budget. In India, the most important activity is to accelerate the rate of economic development, and for that resources are allocated on a large scale. Redistributive activities. The important problems for our developing economy are the problem of poverty, unemployment, income inequalities, illiteracy, etc. In India, serious efforts are being made to solve these problems. For this, the government redistributes income and wealth to reduce inequalities by incurring expenditures on social security and giving subsidies for public work, etc. Economic stability. Inflation and deflation both are not good from economic point of view. Therefore, whenever a country suffers from inflation or deflation, beside other corrective measures, appropriate budgetary steps are taken to remedy the situation. Management of public enterprises. To curb monopolies in heavy, basic and key sectors owned and managed by private enterprises, government establishes and operates such units in the public sector. This is necessary to avoid distortion of priorities of the government and society. Redistribution of income and wealth. Income redistribution is a practice which is designed to level incomes across a society through the transfer of income from wealthier individual to poorer individual, either directly or indirectly. One of the classic forms of income redistribution is a progressive tax system in which people are taxed at different rates depending on their incomes. Tax funds are used to benefit society as a whole by providing a variety of public and social services, and direct transfer of income may occur in the case of welfare payment and other forms of cash assistance made to low-income members of society. The goal of income distribution is not to make all incomes equal by taking money away from some people and giving it to others. Reallocation of resources. Resource allocation is the distribution of resources, usually financial, among competing groups of people or programs. It is because of increasing demand for healthcare services and rising costs to provide those services, people must choose how to allocate healthcare dollars. Resource allocation. The allocation of funds is the main objective of any budget. Normally, expenditure that helps you achieve your goals will get the larger portion of your funds, while lower priority items will allocate a smaller portion. Economic stability. Economic stability is desirable because it encourages economic growth that brings prosperity and employment, and is one of the main objectives enshrined in the management of economic and monetary union and the euro. Managing public enterprises. Public enterprise means the ownership and operation of industrial, financial and commercial undertaking. All industrial and commercial undertakings owned, managed and controlled by the government are called public enterprises or public undertakings or public sector undertaking. These enterprises are known collectively as the public sector. To understand the public enterprises in a better way, we should know its characteristics, which are as follows. Characteristic of public enterprises. State ownership. A public enterprise is wholly owned by the central government or state governments or local authority, or jointly owned by two or more of them. In case the enterprise is owned both by the government and private sector, the state must have at least 55% share in ownership. State control. The ultimate control of a public enterprise lies with the government, which appoints its board of directors and the chief executive. Government financing. The whole or a major portion of the capital of a public enterprise is provided by the government. Service motive. The primary aim of a public enterprise is to render service to the society at large. It may have even to incur losses for this purpose. However, public enterprises are expected to generate surplus in course of time. Public accountability. Public enterprises are financed out of public money. Therefore, they are accountable for the results to the elected representatives of the public, that is the parliament and state legislature. Autonomous bodies. Public enterprises are autonomous or semi-autonomous bodies. In some cases, they work under the control of government departments. In other cases, these enterprises function as companies and statutory corporations. Classification of receipts. In the above discussion, we talk about government budget, types of budget, and so on. But from where we get the money to finance these budgets? In this section, I will introduce you to the receipt. In national accounts, receipt can be treated in one of two ways, either as financial transaction such as issuing debt, lending or purchasing of shares which in themselves do not impact on level of public spending, the current balance or net borrowing, but may impact public sector net debt. Non-financial transaction may be broken down into current receipt and capital receipt, and which affects measures of public sector net borrowing and debt. Types of receipt. Taxes. For a receipt to be classified as tax, it must therefore be both compulsory and unrequited. Compulsory. There are almost no actions that are truly compulsory. Example, if you wish to avoid paying income tax, then you could stop earning an income. Unrequited. There is a very narrow definition of what it means to be requited. If a payment of £X is made, then £X of service should be provided in return. If the service provided is less than £X and the rest of the payment goes towards subsidizing another group, then clearly the payment was not fully requited. This can, however, allow for an appropriate market rate of return to be achieved without becoming unrequired. Revenue receipt. Revenue receipts are available for distribution as profits only after deducting revenue expenses. Revenue receipt can be utilized for creating a reserve fund after deducting revenue expenses. The survival of a business, mainly the capital received during and depends on the revenue received during accounting period. Revenue receipts are the sources for creating revenue reserve. It has short-term effect. The benefit is enjoyed within one accounting period. It occurs repeatedly. It is recurring and regular. This does not increase or decrease the value of asset or liability. Capital receipt. Capital receipts are not available for distribution as profit. Capital receipt cannot be utilized for creating a reserve fund. A business can survive without any accounting period. Capital receipts are the sources for creating capital reserve. It has long-term effect. The benefit is enjoyed for many years in future. It does not occur again and again. It is a non-recurring and irregular. Capital receipt, when invested, produces revenue receipt. Example, when capital is invested by the owner, business gets revenue received, that is sale proceeds of good, etc. Sometimes expenses of revenue nature are to be incurred for such receipt. Example, on obtaining loan, a capital received interest is paid until its repayment. After studying about the receipt, you must be thinking that how these receipts are used. In this section, we will study about the classification of expenditure. Classification of public expenditure refers to the systematic arrangement of different items on which the government incurs expenditure. Capital expenditure. Capital expenditure includes costs incurred on the acquisition of a fixed asset and any subsequent expenditure that increases the earning capacity of an existing fixed asset. Cost of acquisition not only includes the cost of purchases but also any additional costs incurred in bringing the fixed asset into its present location and condition. Capital expenditure may include the following: purchase costs less any discount receipt, delivery costs, legal charges, installation costs, upgradation costs, replacement costs. Capital expenditure includes such costs as delivery of fixed asset, installation of fixed asset, improvement but not repair of fixed asset, legal costs of buying property, demolition costs, architect's fees. Some of the example of the capital expenditure: costs of goodwill, costs of freehold land and building and the legal charges incurred in this connection, costs of lease, cost of machineries, plants, tools, fixtures, etc. Revenue expenditure. Revenue expenditure incurred on fixed assets include costs that are aimed at maintaining rather than enhancing the earning capacity of the asset. These are costs that are incurred on a regular basis and the benefit from these costs is obtained over a relatively short period of time. Revenue costs comprise of the following: repair costs, maintenance charges, repainting costs, renewable expenses. Here are some of the examples of the revenue expenditure. Wages paid to factory workers, oil to lubricate machines, power required running machine or motor. To classify expenditure as revenue or capital, one should be clear about the differences between them. Difference between capital and revenue expenditure. A capital expenditure results in an addition to an asset account, whereas revenue expenditure results in an additional to an expense account. Capital expenditure are payments for asset alteration, addition and replacement, where revenue expenditure benefit a current period and are made for maintaining asset with routine repairs or replacement of a minor part. A capital expenditure will benefit 2 or more accounting periods through depreciation process and expenses for future accounting periods. I hope you understood this concept that I just explained. Now we will move further and study deficit. Government deficit, a financial situation that occurs when an entity has more money going out than coming in, is termed as the government deficit. Government budget deficit can be curbed by cutting spending, raising taxes, or a combination of the two. Deficit must be financed by borrowing money. Interest must be paid on borrowed funds, which worsens the deficit. The government deficit grows during the time of the recession. The government is running a budget deficit. It means that in a given year, total government expenditure exceeds total tax revenue. A budget deficit can have positive macroeconomic effects in the long run if it is used to finance extra capital spending that leads to an increase in the stock of national asset. Some economic effects of a budget deficit: increased borrowing, higher debt interest payment, higher taxes and lower spending, increased interest rates, crowding out, inflation. There are 3 types of the government deficit. Revenue deficit. A mismatch in the expected revenue and expenditure can result in revenue deficit. Revenue deficit arises when the government's actual net receipt is lower than the projected receipt. On the contrary, if the actual receipts are higher than expected one, it is termed as revenue surplus. A revenue deficit does not mean actual loss of revenue. Fiscal deficit. Fiscal deficit happen as a result of revenue deficit. After the government projects its net gain for the year, the leaders presume that they will have a certain net amount of funds for operational needs. At the end of the fiscal year, if the actual total expenditure surpasses the projected revenues, then the government will expenditure a fiscal deficit. Unexpected expenses such as assistance to areas affected by natural disaster or allocation to struggling organization are reason for the increase in expenditures. The elements of the fiscal deficit are the revenue deficit, which is the difference between the government's current or revenue, expenditure and total current receipt, that is excluding borrowing, and capital expenditure. The fiscal deficit can be financed by borrowing from the Reserve Bank of India, which is also called deficit financing or money creation, and market borrowing from the money market, that is mainly from banks. Primary deficit. Because the government now has a fiscal deficit, it needs to borrow money from a lending institution such as a bank to cover its expenditures. Interest on the loan has to be paid to the bank. The interest payment is subtracted from the amount of the fiscal deficit and is referred to as the primary deficit.
Now let's take a look at the connection between high fiscal deficit and slow growth. Fiscal deficit is nothing but if I spend more versus how much I earn. The difference is fiscal deficit. To understand fiscal deficit and growth, we need to understand 2 large policies. The first policy is the monetary policy. That is controlled by the RBI, that looks after the supply of money in the economy and the rate of interest. The second is the fiscal policy. That is looked after by the government, that looks after all the expenditure and the income. Now, when the government spends more than what it earns, it needs to borrow that much money. That money it borrows from the RBI. Now, when RBI has to give the government money, it has to print more money. When it prints more money, it increases the supply of money and there is pressure on inflation. And when there is pressure on inflation, the RBI cannot cut interest rates and keep it low. That is the connection between fiscal deficit, supply of money, inflation and interest rates. We saw the relationship between high deficit and high interest rates. Now, when interest rates are high, they're not really great news for people like you and me. We put a lot of money in the banks, and when we put money in the banks to get higher interest rate, we spend less. We spend less, we consume less, we buy less cars, we go less to restaurants, we buy less goods and services. Companies don't like high interest rates because when companies borrow money from the banks, they pay more and that reduces their profitability. Therefore, high interest rates are not necessarily a good news for the economy. So, high fiscal deficit leads to a higher rate of interest. A higher rate of interest leads to a slower growth. Hence, if the government wants the growth to be higher, it has to keep the fiscal deficit in check. And that is the link between fiscal deficit and growth.
Fiscal policy and its role. Fiscal policy is the means by which a government adjusts its level of spending in order to monitor and influence a nation's economy. The role of fiscal policy in developed economies is to maintain full employment and stabilize growth. In contrast, in developing countries, fiscal policy is used to create an environment for rapid economic growth. The role of fiscal policy, the national government's plan, discretionary balance between the outlays and recurrent revenue. Fiscal policy has been a great success in developed countries, but only partially so in developing countries. Following are some of the reasons that are hindrances for its implementation in developing countries. A sizable portion of the most developing economies is non-monetized, rendering fiscal measures of the government ineffective and self-defeating. Lack of statistical information as regards the income, expenditure, savings, investment, employment, etc. makes it difficult for the public authorities to formulate a rational and effective fiscal policy. Fiscal policy cannot succeed unless people understand its implication and cooperation with the government in its implication. This is due to the fact that in developing countries, majorities of the people are illiterate. Large-scale tax evasion by people who are not conscious of their roles in development has an impact on fiscal policy. Fiscal policy requires efficient administrative machinery to be successful. Most developing economies have corrupt and inefficient administration that fail to implement the requisite measure vis-a-vis the implementation of fiscal policy. Expansionary fiscal policy aims to boost demand and output in the economy either directly through greater government expenditure or indirectly through tax reduction that stimulate private consumption and investment spending. Standardized surplus provides a good way to measure these discretionary changes by correcting the actual budget surplus for changes due to the effects of automatic stabilizers. Let us summarize all that we have learned in the lecture. Government budget is a statement of estimates of the government receipt and government expenditure during the period of the financial year. Types of budget: capital budget, proposed budget, department budget, discretionary and mandatory spending, balanced budget, unbalanced budget, surplus budget, deficit budget. Principles of good budget are comprehensive, predictability, contestability, transparency, and periodicity. Receipts are classified into three categories: tax received by the government. Revenue received are available for distribution as profits only after deducting revenue expenses. Revenue received can be utilized for creating a reserve fund after deducting revenue expenses. Capital received are not available for distribution as profits. Capital received cannot be utilized for creating a reserve fund. Capital expenditures are incurred to buy new capital goods, whereas revenue expenditure are done for maintaining the existing goods. Deficits are the excess of government expenditure over its revenue.